What if I told you that for thousands of years people built houses, traded across oceans, funded wars, and financed entire civilizations without a single bank? No vaults, no credit cards, no central bank, no ATMs. And yet, money moved. Debt was tracked, wealth was stored, power was controlled. Before modern banking, there was a system, a quiet system, a human system. One built on trust, reputation, craft, grain, silver, and sometimes nothing more than a handshake witnessed by the community. And now tonight we're stepping into a world before banks existed and uncovering the hidden financial networks that powered civilization. If you think banking started with marble buildings and suited clerks, this story is about to change your perspective completely. Because long before the first official banks opened their doors, the system was already running. And it worked. Let's begin. The earliest financial system didn't look like money at all. It looked like clay. In ancient Mesopotamia, and in cities like Uruk and Babylon, people pressed wedge-shaped symbols into wet clay tablets. These weren't poems or laws at first. They were receipts. A farmer would store grain in a temple warehouse. The temple official would press a mark into clay, recording how much was deposited. That tablet became proof of claim. Not coins, not paper, but a record. And that record could be transferred. If the farmer owed someone grain, he could hand over the tablet. The creditor could claim the grain later. In other words, 5,000 years ago, people were already using something remarkably close to a check. Temples and palaces acted as central clearing houses. They weren't banks in the modern sense, but they held deposits, issued credit and tracked debt. The economy ran on trust in the institution and trust in written record. Debt came before coin. That fact alone reshapes how we understand money. The world's first known legal code, issued by Hammurabi, included detailed laws about interest rates, collateral and repayment schedules. By the 18th century BCE, financial regulation already existed. Interest rates were capped, contracts were formalized, defaults had consequences. But even then, the system wasn't built on anonymous corporations. It was built on relationships. And that's where the real story begins. In small communities across the ancient world, reputation was currency. If you were known as reliable, you could receive goods today and promise to repay later. If you failed to repay, you didn't just lose assets, you lost social standing. In many early societies, economic trust was inseparable from moral character. Fast forward to classical Greece. In the marketplaces of Athens, money changers known as trapezitai operated from small tables. They exchanged foreign coins, verified metal purity, and eventually began holding deposits. But even then, formal banks were rare. Instead, much of the lending and financing was private. Wealthy individuals funded ships, trade expeditions, and construction projects. Maritime loans were common, high risk, high reward. If the ship returned safely, the lender earned profit. If it sank, the debt could be voided. This was risk-sharing long before Wall Street, now moved to the Roman world. In Rome, financial life became more sophisticated. Moneylenders known as argentarii operated in public forums. They kept ledgers, transferred funds between accounts, and even facilitated payments without coins physically changing hands. If two Roman citizens both had accounts with the same lender, payments could be settled by adjusting numbers in a ledger. No coin, no metal, just accounting. Sound familiar? The Romans had checks, deposit accounts, and credit systems centuries before modern banks formalized them. But after the Western Roman Empire fell, Europe fractured. Coin shortages became common. Trade shrank. So how did commerce survive? Through guilds. In medieval towns, craft guilds became powerful economic institutions. Organizations like the Carpenters' Company of the City and County of Philadelphia, though much later in origin, reflect an older European tradition. Guilds weren't just trade associations. They regulated quality, controlled apprenticeship, provided social insurance, and extended credit among members. If a craftsman fell ill, the guild might support his family. If he needed materials before a sale, fellow members could extend goods on trust. The guild was a financial safety net. But even more fascinating were merchant networks. In the Islamic world, during the medieval period, traders developed a system known as hawala, an informal method of transferring money across long distances without physically moving it. A merchant in Baghdad could give money to a broker. That broker would instruct a partner in Cairo to pay the equivalent amount to the intended recipient. The debt between brokers would be settled later through trade flows. No vault, no armored carriage, just trust, reputation, and a network. Hawala systems still exist today. Meanwhile, in Europe, Jewish merchant families created similar cross-border financial networks. Because they were often restricted from owning land or joining guilds, finance became a viable economic path. Letters of credit emerged. Instead of carrying heavy, easily stolen coins across dangerous roads, a merchant could carry a letter guaranteeing payment at a distant city. If robbed, the paper was useless without proper identification. Security through documentation. In Renaissance Italy, cities like Florence and Venice became financial powerhouses. Merchant families, most famously the Medici Bank, expanded deposit and credit systems. But even then, banking was deeply personal. The Medici weren't just bankers, they were political actors, art patrons, power brokers. Or stick would be split in two. One half kept by the seller, the other by the buyer. The seller would mark the stick with a tally, a notch, or a mark. The buyer would mark the stick with a tally, a notch, or a mark. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. The seller would return the stick to the buyer. The buyer would return the stick to the seller. Stick would be split in two. One half kept by the creditor, one by the debtor. The matching notches proved authenticity. England used tally sticks for tax records for centuries. even into the 1800s. The system was simple but effective. So what did all these systems have in common? They were decentralized. They were based on human networks. They relied on social enforcement rather than centralized authority. Now let's step into colonial America. In the 1700s, coin shortages plagued the colonies. British mercantilist policy restricted currency flow. So colonists turned to alternative systems. They used commodity money, tobacco in Virginia, for example, as legal tender. They issued paper bills of credit backed by land or tax revenue. In local trust filled the gaps where formal banking infrastructure didn't exist. When institutions like the Bank of North America and later the First Bank of the United States emerged, they didn't invent finance, they centralized it. That's the key distinction. Banking didn't create economic trust, it institutionalized it. But centralization changes power dynamics. Before banks, if you wanted credit, you needed relationships. Community mattered, character mattered. After banks, yet your collateral and capital mattered more. The transformation wasn't just economic, it was cultural. In earlier systems, debt could be negotiated face to face. It could be forgiven in times of crisis. In some ancient societies, periodic debt jubilees were declared, wiping slates clean to prevent social collapse. Kings understood something critical. Excessive debt could destabilize the entire system. Today, we rarely see debt cancellation at that scale. In medieval Japan, merchant houses developed their own accounting systems. In West Africa, trade routes across the Sahara were financed through partnership agreements. In China, remittance shops during the Ming Dynasty allowed long-distance money transfer centuries before Western banks perfected the model. Across continents, the pattern repeats. Before banks, there were networks. Before institutions, there were communities. Before digital balances, there were promises. So why did banks eventually dominate scale? As trade expanded globally, personal trust networks became insufficient. You couldn't personally know every merchant across oceans. Institutions replaced familiarity. Standardization replaced reputation. Contracts replaced handshakes. But something was lost in the transition. Earlier systems embedded morality into finance. Breaking trust meant social exile. Financial failure was communal, not abstract. Modern banking separated finance from community. Your lender may never meet you. Once your debt can be sold, your obligation becomes data. And yet, ironically, the oldest systems are resurfacing. Peer-to-peer lending echoes ancient private credit. Community lending circles resemble medieval guild support systems. Informal remittance networks mirror hawala structures. Even digital currencies attempt to decentralize trust again, replacing institutions with cryptographic consensus. History loops. The banking system before banks wasn't primitive, it was adaptive. It evolved organically from human needs. It balanced risk, trust, and survival. And in many ways, it reminds us that finance is not inherently about buildings or vaults. It's about belief. Belief that a promise made today will be honored tomorrow. Before we end, consider this. If tomorrow every modern bank vanished, would commerce stop? Or would we rebuild networks, just as humans have done for thousands of years? The truth is, we've done this before. Civilizations rose, traded, collapsed, and rebuilt long before the first modern bank charter was signed. The system isn't the marble building. It never was. It's us. And that might be the most powerful financial truth in history. If this changed how you see money, debt, or power, let me know in the comments. Do you think decentralized systems are stronger than centralized banks? Or do we need institutions to maintain stability? Because the future of finance may look a lot more like the past than we expect.